Something just happened in China that every silver and gold holder needs to know about. I'm not talking about the Bloomberg story that crashed silver this week. I'm not talking about the Russia dollar deal. I'm talking about something that went completely under the radar while everyone was distracted by those headlines. And honestly, this might be bigger than all of it. On February 13th, at exactly 9:49 a.m. local time, Shenzhen's Financial Regulatory Bureau dropped a bombshell. A joint announcement backed by 10 government departments. Not one, not two, 10. Including the People's Bank of China, Public Security, the Securities Commission, Market Supervision. Every regulator that matters in China signed the same document. And it said one thing: if you're running fake gold or silver trading operations, stop immediately or face criminal prosecution. China just declared war on unlicensed paper precious metals schemes, the shadow market where fake physical trading was hiding and leveraged gambling. And this is the first time any major government has cracked down this hard on paper gold and silver manipulation. Let that sink in before we go any further. Welcome to the hidden economy. Like and subscribe. Let's get into it. Now, to understand why China dropped this order right before their biggest holiday of the year, I need to take you inside what's been happening in a place called Shuibei. If you've never heard of Shuibei, listen carefully because this place is about to become very important to your understanding of the silver market. Shuibei is a district in Shenzhen. It's the beating heart of China's entire gold and silver industry. Thousands of traders, manufacturers, wholesalers, all packed into one area. This is where physical precious metals move in China. If gold and silver have a capital city in Asia, Shuibei is it. And in late January, Shuibei blew up. A company called JWR, or Jewelry Jewelry, had built one of the biggest gold trading platforms in the district. On the surface, it looked like a physical gold business. Customers would open a mini program on their phone, see a live gold price, and lock in a purchase. Simple? Clean? Looked completely legitimate. But here's what was actually happening behind the scenes. Customers were paying a deposit as low as 20 yuan per gram to lock a price. That's a fraction of the real cost. They weren't buying gold. They were placing leveraged bets on the gold price. If the price went up, they'd close their position and take the profit. If it went down, they'd lose their deposit. No physical gold was ever delivered. No real metal ever changed hands. The platform called it pre-priced gold trading. What it actually was an unlicensed futures operation running 40 times leverage on gold through a phone app. And it worked, for a while. JWR grew massive. They attracted investors from all over China through social media. They promoted zero processing fees and high-priced buybacks. They were aggressive, and people poured money in because gold kept going up and everyone was making money on paper. Then January happened. Gold prices surged, and suddenly everyone wanted to cash out at the same time. Classic bank run. The platform couldn't pay. They limited withdrawals to 1 gram of gold or 500 yuan per day. That's about $70 a day for people who had millions of yuan locked up in the system. Investors from provinces across China flew to Shenzhen. Thousands showed up at JWR's offices. It turned into street protests. Police were called in. People were physically confronted. The estimated damage? Over 10 billion yuan, 1.4 billion US dollars. Some estimates say more than 150,000 people were affected. $1.4 billion vanished from one platform in one district in one city. But here's the thing. JWR wasn't the only one. A second platform called WID07 collapsed right after. Same area, same scheme. Investors from other provinces traveled to Shuibei demanding payouts. And then a major silver dealer in the same district defaulted on physical delivery. Over 350 people waiting for silver that was never coming. Shuibei was in chaos right before Chinese New Year, right before the biggest holiday in China. Protests in the streets of a major financial district during Spring Festival is the last thing any government wants. So 10 departments came together and dropped the hammer. And what they put in this document should scare every paper gold and silver dealer on the planet. The order is direct: gold forward pricing, leverage trading, deferred settlements. If you're running any of this through internet platforms, WeChat groups, mini programs, apps, websites, it doesn't matter. If your clients are paying deposits, trading price differences, and closing positions without ever taking physical delivery, you are now a criminal in Shenzhen. Not a bad actor, not under investigation, a criminal. And here's the part that most people are missing. And this regulatory gap had existed for years. Gold trading in China fell into a no man's land. One bureau thought another bureau was handling it. That bureau thought a third one was responsible. The Securities Commission couldn't touch it because it involved physical delivery. The exchanges had no enforcement power over these transactions because they were happening off the books. 5 or 6 different agencies all pointing at each other, saying it's not my problem. Everyone was involved. Nobody was in charge. For years, these paper gold platforms operated in a regulatory void where nobody could touch them. That void just got filled. Someone finally took responsibility. And they didn't come with warnings. They came with the police behind them, but they didn't stop there. And this next part is what nobody else is talking about. The announcement also makes something very clear. This isn't just about the platforms themselves. Third-party tech companies that built the mini programs, the apps, the trading systems, they're also on the hook. If you developed the software that powered these fake gold trading schemes, you face supervision and legal responsibility too. China isn't just going after the dealers, they're going after the infrastructure. Now here's where I want you to really think about what this means. Not just for China, for the entire global precious metals market. What these Shuibei platforms were doing is not unique to China, selling paper gold and silver to customers who think they're buying physical metal, settling on price differences without ever delivering real metal, using leverage to amplify bets, creating the illusion of supply that doesn't exist. Now pause for a second and ask yourself, does any of that sound familiar? This is what happens on Western exchanges every single day. Paper contracts trade in volumes that dwarf the amount of physical metal that actually exists. The price you see on your screen when you check silver is not determined by how much physical silver is available. It's determined by how many paper contracts are being created and traded by institutions with deep enough pockets to move the market. When silver was ripping higher, CME raised margin requirements. Not once, multiple times. Each hike forced leveraged longs to liquidate. Prices crashed. And the people who were selling paper short got exactly the relief they needed. The exchanges didn't protect retail traders. They protected the institutions on the other side of the trade. China just looked at this exact same dynamic happening within its own borders and said, this is illegal. This is fraud. Stop it now or go to prison. The US hasn't done this. The UK hasn't done this. COMEX still operates the same way it has for decades. The same banks that paid hundreds of millions in fines for manipulating precious metals are still active participants in these markets. No 10-department joint order, no criminal prosecution threats, no emergency announcements. And I want to be fair here. China didn't do this because they suddenly care about fair markets. They did it because the JWR collapse created a crisis. Protests, political embarrassment, financial instability. They acted out of necessity, not principle. But here's the thing about consequences. They don't care about your intentions. Whether China banned paper trading to protect investors or to save face politically, the result is the same. The second largest economy on earth just told its entire precious metals industry that if you're trading gold or silver without physical delivery, you're a criminal. Think about what that means for demand. Chinese investors who were speculating on gold through paper platforms now have 2 choices. Stop investing in precious metals entirely or buy physical. Real gold, real silver, metal they can hold. Metal that has to be delivered. There is no third option anymore. The paper alternative just got made illegal. Now here's where it gets real. When you force an entire market's speculative energy into physical buying, that metal has to come from somewhere. It has to be mined, refined, shipped, and delivered. You can't print it. You can't create it with a keystroke. You can't settle it in cash and pretend it exists. And that, right there, is the fundamental difference between what just happened in China and what continues to happen in the West. In China, if you sell gold or silver you don't have, you go to jail. In the West, if you sell gold or silver you don't have, you get a bonus. Now listen to this. From the original announcement, they said they're giving companies time to adjust before Spring Festival. They said if you come back after the holiday and you haven't changed your business, the regulators will truly come for you. This isn't a suggestion. This isn't guidance. This is a deadline with handcuffs attached. And they specifically referenced what happened in 2015 and 2016 when the State Council did a similar cleanup of trading venues. People were directly arrested. No warnings. No grace period. Arrested. The fact that they're referencing that tells you the government is serious. They're reminding the industry what happened last time someone didn't listen. So that's the crackdown. That's what China just did. But now I need to explain why this isn't just a Chinese story. Why this affects you, your portfolio, and the price of every ounce of silver on Earth. And this is why I said at the start of this video that this might be bigger than the Bloomberg memo, bigger than the Russia deal, bigger than all of it. For decades, precious metals price discovery has been controlled by Western paper markets. London and New York set the price. The rest of the world followed. Physical premiums in Shanghai, Mumbai, Dubai, Tokyo, those were treated as local anomalies, noise, not signal. But what happens when the world's biggest physical buyer says paper price discovery is fraud? What happens when they ban it? What happens when they force their entire market toward physical settlement only? You get two prices, a paper price set in New York and a physical price set in Shanghai. And over time, the physical price becomes the one that matters because the physical price is the one backed by actual metal. The paper price is backed by promises. And we just watched what happens when paper promises can't be kept. $1.4 billion in losses, 150,000 people with nothing. This is not theory anymore. This is already happening in front of your eyes. Shanghai and COMEX have been showing different silver prices for months. Go look it up yourself. Physical premiums in Asia have been running well above Western paper prices consistently. Dealers in China, India, Japan, UAE, all quoting physical metal at prices higher than what your screen shows. Two different prices for the same metal, two different realities. And China just took a step that makes that gap permanent by telling its entire market that only physical counts. The Shenzhen announcement is not just a local regulation, it's a philosophical statement. It says, we don't trust paper precious metals markets, we don't trust prices that aren't backed by delivery, and we're willing to use criminal law to enforce that position. No Western regulator has made that statement, no Western exchange has moved in that direction. And until they do, there will be two precious metals markets operating under two completely different sets of rules. One where paper is king, and one where physical is law. For anyone holding physical gold or silver, this is validation. Not because China is on your side, but because the largest physical market in the world just admitted what stackers have been saying for years. Paper isn't real. Unbacked contracts aren't real. Leverage without delivery isn't real. And now in China, it's not just wrong, it's a crime. I'll be watching what happens after Chinese New Year very closely. Will other Chinese cities follow Shenzhen's lead? Will Beijing issue a national order? And the biggest question of all, will the flood of speculative money that used to go into paper platforms now flow into physical metal instead? Because if it does, the physical market is about to get a lot tighter, and nobody's ready for that. That's my take. That's what I think is happening. Drop a comment and tell me, do you think China's crackdown changes the game, or is Western paper still going to control the price? I'll pin the best responses. This is The Hidden Economy. I'll see you in the next one.